Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public via live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. I also would like to note that everyone involved in today's webcast meeting is participating remotely, so if we experience any technical difficulties, I ask for your patience. The first item on our agenda is a board briefing on the latest cybersecurity developments. Staff presenting, Johnny Davis, Special Advisor to the Chairman for Cybersecurity and Director, Division of Critical Infrastructure, Office of Examination and Insurance. Johnny, you may begin when you're ready.
Thank you, Chairman Harper. This is Johnny Davis. Good morning, Chairman, Vice Chairman Hopman, and Board Member Hood. This morning, I will provide a quick update as to the cybersecurity events and trends that have occurred since the last cybersecurity update in 2020, October timeframe. Slide 2, please. The top threats that we've seen in this last quarter have been very similar to the historical threats that we've seen for quite some time now. They remain relevant with some new variants largely based on current events. So ransomware, malware, phishing attempts, identity theft, denial of service, and even ATM skimming continue to be prevalent in the financial services sector. We also see the pandemic-themed attacks for all of these historical trends, where either the pandemic itself or the stimulus activity would be the theme of certain emails or websites and other attacks in this realm. And naturally, from the end of the year, the SolarWinds and Microsoft activity for the new trend on supply chain attacks has been underway. As far as mitigation trends, we continue to see that the foundational critical security controls are, in fact, some of the core root causes under the umbrella of cyber hygiene. And so we'd like to make sure that we continue to express the fact that making yourself a harder target by addressing these cyber hygiene components remains important. Organizational awareness and training on cybersecurity practices, access and asset management awareness as well, along with the effectiveness of security controls that are already in place, not to put them in place at a point of time, but to actually monitor them on a continuous basis to ensure that they remain effective. Consolidate security products and services as much as possible to limit the landscape for likely compromise. And as you can see with the pandemic theme, remote users are more prevalent than they were pre-COVID-19. So an emphasis on that security posture continues to be of great importance. We'd also add that breach and attack simulation prior to an actual event remain important to ensure that your organization and your staff understand exactly what to do in the event of a breach or attack in calmer times. And we'll close this with continuous monitoring, mostly for rapid detection and response. We are at the stage where if a well-qualified, purposeful bad actor wants to get in your environment, they will go to no ends to do so. But the faster you can identify anomalies and respond to those anomalies will be important in your ultimate success. One of the analogies we like to use here is two neighbors. If a criminal is outside of two homes and he sees that one house has a sign for the alarm, they've got locks on the doors and windows, they have a dog, a no trespassing sign, and the other neighbor has none of these controls, naturally they're going to go for the easier target. So we can't stress enough, don't be an easy target. Slide 3. So supply chain attacks are increasing. We've even found one this week that the financial services sector is focusing on as far as virtual private networks in the Pulse Secure solution. So they continue, attackers have found that they can get success with these, and notice that by attacking a virtual private network, you're also taking advantage of our secure remote processes and requirements courtesy of COVID-19. The difference in the supply chain attacks is that it really attacks the entire global ecosystem. So you're not just dealing with vulnerabilities within your environment, you're dealing with vulnerabilities in the entire supply chain where you procure products and services. We have put a great deal of frequently asked questions on our public-facing website to provide some information on supply chain activities, to include items from Department of Homeland Security, Cybersecurity Infrastructure and Security Agency, Critical Infrastructure and Security Agency, excuse me. To add to this, we have planned a tabletop exercise very similar to the one that we did last summer for ransomware. This summer, we'll focus on supply chain attacks. To govern that approach, we are going to leverage the National Institute of Standards and Technology Special Publication 800-161, Supply Chain Risk Management Practices for Federal Information Systems and Organizations. The scenarios for that tabletop exercise will come directly from this NIST guidance, and we look forward to participation from certain credit unions, and I'll talk a bit about that in the next couple of slides going forward. We've added the link to the special publication on this particular slide, and I strongly encourage all institutions to read and become familiar with this as this trend progresses. Slide 4, please. Several years ago, we proactively put a website up that talked to the due diligence that the NCUA has for protection of information, particularly sensitive information collected in our examination and supervision process. This website was a combination of our Chief Information Officer, Rob Foster, Chief Information Security Officer David Tillman, myself, and regional and operating division participants to make sure that we proactively gave you information on how we collect data, the security control, implementation, and management of that data, the transparency of our Office of Inspector General's audits on how well we manage that information. And of note, we plan to put 2 feature updates in this website that highlight our responses for major incidents. We have 7 days by law to provide updates to Congress on any major incident. And for breach reporting, we're required to make sure that not only are consumers notified of such a breach, but also the institution that we've collected the information from in the event that scenario fits. Most of this is governed by the Federal Information Security Modernization Act, but there are other laws to include Privacy Act laws that adhere to our overall security posture. Slide 5, please. So one of the discussions that have come up quite a bit, and I wanted to make sure that we had an opportunity to present this in a larger forum, is compare and contrast for what the federal financial regulators are required to do by way of due diligence in an environment governed by federal laws versus the third-party service provider due diligence that's typically governed by contracts between the credit union, in this case, and the actual system integrator, supplier, or external service provider. They are two slightly different scenarios, and specific to the events of the winter, this is currently still an open all-of-government investigation for SolarWinds. This comes with certain constraints that we must adhere to while that investigation is open. And I would strongly suggest that as the inquiries came to the NCUA, that auditors can be provided with this due diligence statement, as well as a copy of the OIG reports analyzing our security posture to serve as your due diligence within your risk assessment of NCUA moving forward. Next summer, this summer rather, in August, when we do the tabletop for supply chain, we will also have an opportunity for lessons learned similar to the ransomware tabletop of last year to be able to see if there are additional items that should be discussed or considered for due diligence moving forward. Quick overview of logistics, very similar to last year's ransomware. We are partnered with Department of Treasury as the sector-specific agency for financial services, Department of Homeland Security, an array of law enforcement and intelligence resources. We will reach out to the trade associations who can participate as observers, but we also look to them to provide volunteers from their members, credit union members, the institution themselves, not the actual consumer. And we will vet those volunteers to make sure that we have a good distribution of size and complexity for the tabletop, at which point we will convene and produce lessons learned to move forward for the next following year. Slide 6, please. Mr. Chairman, that completes my prepared comments for today's briefing. Thank you for the opportunity, and I'm available to answer your questions.
Johnny, thank you so much for that informative briefing. Like my fellow board members, I am deeply concerned about the risks that cyber attacks pose for our financial system. As noted in your presentation, the COVID-19 pandemic has increased cybersecurity exposures for federally insured credit unions. Phishing, malware, ransomware, and distributed denial of service attacks are just some of the ways that cyber criminals exploit vulnerabilities within the credit union industry and the broader financial system. To compete, credit unions must be able to safely and securely use technology to deliver member services and adopt financial innovations to ensure the industry's long-term success. We must all work together to promote innovation with an emphasis on security and equity. Each of us, the NCUA, state supervisory authorities, vendors, and credit unions, has a responsibility to protect our systems, improve our ability to recover from incidents, educate our staff, share information, and report and address potential vulnerabilities. Briefings like this one today are a critical part of our efforts to promote cybersecurity best practices and inform credit unions about the potential threats they face. I encourage credit unions to utilize the information sharing groups and other resources presented in this briefing. For many credit unions that are balancing several priorities, it may seem that resources are not available to help improve cybersecurity preparedness. However, as part of the NCUA's 2021 Community Development Revolving Loan Fund Grant Initiative, low-income credit unions can apply for up to $7,000 grants to strengthen their cybersecurity defenses. The application period runs May 3rd through June 26th, and I encourage all eligible credit unions to consider applying for these grants. Johnny, I now have a few questions for you. First, why is ransomware still so successful despite all the news and information about this type of malware and how to avoid it?
Yes, sir. This is Johnny Davis. I believe state actors, organized crime members, who have the motivation, skill, and patience to want to use this particular attack method know that the root causes that make it successful continue to be a challenge for our country at large, if not the world at large. And those are cyber hygiene and social engineering, as mentioned on slide 2. Specifically, the rigor of keeping cyber hygiene maintained requires prioritization, dedication, and diligence of both operational and security resources, along with prompt remediation and continuous monitoring. And that has eluded us for quite some time as a collective user of IT technology. I also think critical function systems and data must be backed up, replicated, and tested for restoration as required by contingency and disaster recovery plans. So to my earlier point, making sure that of all controls, this particular control is in fact paid attention to with a great deal of caution. And I say that because the ransoms are usually directly derived from returning systems operation to normal status or returning data itself. That's the end of my response, sir.
Johnny, thank you for those observations. I want to follow up. What happens after a ransomware payment is made to a suspicious account? What can credit unions do to stop these types of transactions?
Yes, sir. This is Johnny Davis. Theoretically, the attacker should return the data or system functionality and remove conditions for repeat attack. But there's not typically honor among thieves, and this does not always happen. So on many cases, the attacker will use that information further for reputation embarrassment of the organization, or sell it themselves to another organization that might do a similar attack. And so this is why we say become a harder target by focusing on those critical security controls, but also listen to your law enforcement recommendation. Most law enforcement on most conditions will say do not pay the ransom, particularly because there's no guarantee that any of the conditions of the ransom are actually going to be honored. The best defense in this would be to make sure that you have your data and systems in a resilient posture and can therefore recover from any such attack. I also, from an advisory perspective, believe, and this is my personal opinion, that we as a collective federal services sector could do additional deliberation around what we can stop by way of successful ransom motivation through our ecosystem. This is prior to any monetary funds being actually provided to cryptocurrency environments, but while it's in our financial services sector, there should be certain triggers and responses that we can do in order to make sure we're not actually aiding in the success of ransomware attacks. That's my response, sir.
Thank you for that detailed answer, Johnny. Finally, I want to take a slightly different tack here. And what are some of the low-cost training tools that credit unions can use to boost their cyber resilience? As you know, Johnny, 2/3 of credit unions have $100 million or less in assets. And do we have that information available on the NCUA's Cybersecurity Resources webpage for easy access for them?
Sir, this is Johnny Davis. Without mentioning any specific companies, I would suggest, with an understanding that training is not necessarily just in the classroom as opposed to having access to resources as you mentioned, I believe the Department of Homeland Security's Critical Infrastructure and Security Agency, CISA, our own Credit Union Resource and Expansion Learning Management System and the National Institute of Standards and Technology have a wealth of information on their websites. I know that the credit union trade associations have a good deal of training that they've invested in and deliver to their member organizations. I also believe that the information sharing organizations that you could typically find on ISO.org, and these are typically free services and unique to local environments. They have a good deal of information that could assist in the resilience awareness. And believe it or not, local community colleges and trade schools are a wealth of efficient training for cybersecurity. That ends my response, sir.
Johnny, thank you for those detailed ideas. I know that credit unions will appreciate them. In closing, all credit unions, regardless of size, are vulnerable to potential cyber attacks. The NCUA is committed to strengthening the readiness of the credit union system to respond to these risks through our supervisory program, training, and the Community Development Revolving Loan Fund Grants and Loan Program. I look forward to continuing to work with Vice Chairman Hoffman and Board Member Hood on this important issue. Thank you again, Johnny. I now recognize Vice Chairman Hoffman for his comments.
Thank you very much, Chairman, and thank you, Mr. Davis. Let me say this. We've said this before, but the pandemic was like hitting fast forward on a lot of things, including moving to digital services. It probably took 10 years of evolution and made it into 1 year. Credit unions were no exception. In the last year, apparently 6 million credit union members signed up for online access. 71 million of 125 million use the online services, and that's a number that goes up, not down. Mr. Davis, your presentation today is a reminder for all of us, and I'd like to thank you and all of the staff engaged in this substantial work. I'd also like to thank Board Member Hood for elevating your position to Special Advisor to the Chairman. It was a recent and important move that continues to serve the agency. And I've been informed that you're one of the higher performing NCUA employees. I have just one question. A lot of the losses to the Share Insurance Fund are from internal fraud by credit union employees. We recently had to deal with a decades-old credit union that collapsed entirely because of fraud by one of its employees. It wasn't because loans went bad. It was internal fraud. It was an inside job. Mr. Davis, your regularly scheduled briefings give us an opportunity we wouldn't have otherwise to shine a light on fraud detection or prevention. Now, I understand credit unions have a myriad of systems and requirements to protect against fraud, cyber fraud or otherwise, but can you elaborate on strategies that you think would deter or detect internal fraud?
Yes, sir. This is Johnny Davis. I think in addition to the fraud programs that we have in place at NCUA and are represented within the credit unions, I believe there's an opportunity within our required examination criteria to increase the emphasis on certain privacy and security controls that lend themselves to identifying and deterring fraud, specifically around access management. So naturally, fraud, cyber-enabled specifically, has to have an inappropriate amount of access given at some point in time. So practices of what we call least privilege, meaning only giving enough access for someone to do their job, nothing more, nothing less, and when they transfer in different positions in an organization, that must be maintained appropriately. That least privilege, coupled with separation of duty, which is the practice of making sure that the person who cuts the check can't also authorize the check, for example. Those practices must be in place. And I think something fairly unique that typically has existed on the classified side, but is also a security control in the National Institute of Standards and Technology requirements for controls, as well as other standards for that matter, is the creation of an insider threat program. We would like to not only heighten the emphasis on those controls I mentioned in all of our exams going forward, but this October for Cybersecurity Month, and we'll span September and October as well, because September is actually Insider Threat Awareness Month, while October is Cybersecurity Month. We'd actually like to have a forum with credit unions, similar to the tabletop scenario I described during the presentation, where we can talk through best practices of implementing an insider threat program at the institutions. I think what this gives them, to your earlier point, is it will actually create trends and alerts of behavior so that they can identify abnormalities within their environment. For example, if you have an employee who typically works Monday through Friday, 9 to 5, never deviates from that for the most part, and all of a sudden you see in your log that there's activity at 2 o'clock in the morning downloading substantial amounts of data in encrypted format, to be elaborate in that scenario, that's a flag for further investigation. And as long as you have the right participants, your HR organization, your security organization, your financial organization, and otherwise, you'll make sure that you temper the benefits of the insider threat from the perception of a Big Brother scenario unwarranted. That ends my response, sir.
All right. Yeah. Thank you, Johnny. It's just one thing I've noticed in my brief time here is, going back to your analogy about the two houses, one's a hard target. We can have all the security guards circling your credit and alarm systems we want, but it turns out that often the real problem is the employees who are already inside. And again, we've already seen losses to the SIF because of that. So I think that is incredibly important, and that will help us. Thank you, Johnny, and Mr. Chairman, that concludes my remarks.
Thank you so much, Vice Chairman Hoffman. Board Member Hood, do you have any remarks?
Yes, and good morning, and thank you, Mr. Chairman. I just want to begin first and foremost by thanking you, Johnny, for your aplomb and professionalism exhibited in today's presentation, and also thank you for the hard work you've done to really keep cybersecurity top of mind, both at the agency and throughout the credit union industry. About a year ago, as COVID-19 first spread to the United States, I said that while we would maneuver our way through working remotely during the pandemic, the NCUA and credit unions must ensure financial services remain resilient during these difficult times. With the current remote posture for the NCUA and many credit unions, it requires today an even greater focus on resiliency, especially for cybersecurity issues. With new account fraud, identity theft, cybersecurity risk, and mobile banking application fraud, all on the rise as a result of the opportunities related to the ongoing COVID-19 pandemic. Now, it is as important as ever that we remain vigilant of potential cybersecurity threats. It's also important that we harden our cyber defenses at the NCUA and throughout the industry. The NCUA Office of Inspector General has called on Congress to give the NCUA vendor authority. I am supportive of NCUA gaining vendor authority. Indeed, in fact, I supported vendor authority during my last tenure on this board over a decade ago. Vendor authority has been called upon by the Federal Stability Oversight Council and the Government Accountability Office. So I do think it's a tool that we need in our toolbox. But we should be especially mindful of how we use this tool if we are granted this authority by Congress. Overall, I believe it would be best for Congress to consider giving us vendor authority post-recovery. With that in mind, Johnny, I have a question, and that is, if NCUA obtained vendor authority in the near term, how many additional headcount would be required based on the agency's recent estimate?
Yes, sir. This is Johnny Davis. I'd say that our preliminary estimates are somewhere around 8 and 11 additional staff at an incremental level. This is approximately $1.7 or $2 million at full capacity. But I think more than the staffing level and associated costs, the importance, at least from the inquiries that I've been getting from the industry, are around our actual approach. And so I think it's important to note that our focus would be only on those significant service providers in the core processor and payment arenas that are not already covered by the work we do jointly with the FFIEC and our banking counterparts. The selected entities would also need to present a significant concentration risk for credit unions in regards to the service and products being consumed. That, coupled with the fact that we don't believe this is something that would happen on an annual basis as much as it would have a 3 to 5 year life cycle, very similar to a collective audit spread or examination spread of security controls in other environments. I think that 3 to 5 year life cycle will also give us an opportunity to continuously measure the effectiveness of that staffing model, as I project that operational efficiencies would occur over time as we get into more core processor and payment environments. That ends my response, sir.
And Johnny, thank you. And to continue with that theme, could you then perhaps give me an idea of what an annualized full-year budget would look like? What would be the cost? Because that's something I want to be mindful of.
Yes, sir. This is Johnny Davis. Again, I think that 8 to 11 personnel would equate to about $1.7 or $2 million annually. Okay.
Thank you. And I would just want to quote an article from a trade publication dated March 22nd, 2015, and entitled NCUA Board Split on Vendor Authority, documented that the FDIC did not increase its budget when it gained the authority in 1999. And I'd just like to note, additionally, in 2005, then our board chairwoman, Matz, testified to Congress that there would be no material change in the budget if NCUA were granted vendor authority. And while I understand cybersecurity has evolved since 2005, it's simply worth noting that costs can often shift in government. I would say that if we were given vendor authority, I would want to work with our fellow board members and our agency leadership to determine if we would look at vendors on a regular basis or only look at those that we believe where there is a threat to the credit union system. So that's worth noting. As the number of credit unions the NCUA supervises continues to decrease with consolidation in the industry, among other factors, if the NCUA does get vendor authority, I am supportive of following the FDIC's model and not increasing the budget to get this new authority, especially at first. If our peer regulator can get additional regulatory authority without increasing their budget, it seems reasonable to me that we could perhaps do the same. Johnny, shifting gears now, could you please provide a quick status update on the implementation of our information technology risk examination for credit unions, along with any relevant training efforts underway for this solution?
Yes, sir. This is Johnny Davis. So my response to that question would be better served coming from our Chief Information Officer and our Chief Information Security Officer. While I am the advisor on an array of cybersecurity matters, the internal agency responsibility currently rests with those two individuals per the Federal Information Security Modernization Act of 2014. I will tell you, consistent to our presentation, that our Office of the Chief Information Officer is partnered with our Office of Business Innovation and Chief Data Officer to implement the Merit solution, consistent with the briefing that they've did a few months ago last year. The security and privacy controls required for that system are identified, implemented, and maintained in accordance with that federal law, as well as with the guidance of the National Institute of Standards and Technology. The effective implementation of the controls for that solution are vital towards Merit actually achieving an authority to operate, or authorization to operate, ATO as we call it, which all federal systems have to have prior to going into a production status. So I believe that following that process, as with all systems, confidentiality, availability, and integrity will need to be aggressively maintained on an ongoing basis to ensure that that system, similar to all of our systems, are prepared for the rigor of the threat landscape and the attacks on the financial services sector. It does not go unnoticed, sir, that you're asking specifically for my opinion in this matter. I would say that I would need to personally gain access to that ATO package and associated tests, plans of actions, and milestones for remedial activity, and any acceptance of risks that have been addressed in that package, along with plans for continuous service improvement. And these are just standard practices that I promote. Prior to any transition of the system to full operating status, I would also require an aggressive neutral party penetration test to really put the system through its paces as an insider and external bad actor would in fact do. That would be my recommendation forward, and as it's been reported to me, our Office of the Chief Information Officer is in fact moving down this path accordingly. That ends my response, sir.
Well, Johnny, thank you for that very thoughtful and detailed response. Finally, and this may be an opinion question as well for you, and that is, should credit unions beta testing Merit feel secure using the platform from a cybersecurity standpoint?
I would say that our due diligence, as previously described, certainly make Merit a much more secure solution than historical solutions that did not necessarily have that same rigor as we've matured our program over the years. But I would not be able to give that advice specifically given my position with that particular program. That ends my comment, sir.
Okay, well, thank you for that response, Johnny. In closing, when I created the cybersecurity advisor to the chairman position, I envisioned this being an all-encompassing position giving recommendations in all facets on NCUA cybersecurity issues, not just those generally pertaining to examination and insurance. For this reason, and in keeping with the initial vision of the position, this year I wish to work with my fellow board members and will call on the NCUA board to modify this position, including having it report directly to the NCUA board. Thank you. I have no further questions or comments.
Thank you so much, Board Member Hood, and I think that we can all agree that we definitely want to continue a focus on the cybersecurity aspect and the importance of it in order to protect the safety and soundness of the credit union system. The second item on our agenda today is a board briefing on Interim Final Rule, Part 702, Capital Adequacy Prompt Corrective Action. Staff presenting, Catherine Metzger, Risk Management Division, Office of Examination and Insurance, and Tom Zels, Staff Attorney, Office of General Counsel. You two may begin when you are ready.
Good morning, and thank you. This is Catherine. We are here to present an interim final rule that will temporarily modify certain prompt corrective regulatory requirements to provide credit unions with additional relief in response to the COVID-19 pandemic. This rule was approved by notation vote of the MCUA board on April 14, 2021. This interim final rule is essentially the renewal of the PCA relief that expired on December 31st, 2020. The regulatory changes discussed today attempt to address situations that may cause a credit union to fall below the well-capitalized classification, generally for a short period of time. This first form of prompt corrective action relief relates to the requirement that credit unions that fall below the adequately capitalized classification must file a net worth restoration plan and applies to credit unions classified as undercapitalized. The second form of prompt corrective action relief relates to the earnings transfer waiver requirements for credit unions that are classified as adequately capitalized. We understand some credit unions may continue to experience a substantial short-term increase in shares and corresponding dilution of the net worth ratio because of stimulus check deposits or consumer increased propensity to save. To provide relief to these credit unions, the final rule would again enable credit unions whose net worth ratio falls below 6% but above 4%, predominantly because of share growth, to submit a streamlined net worth restoration plan to satisfy the requirements of Section 702.202 and 206. The streamlined plan would be exempt from the current regulatory content requirements set forth in Section 702.202 and 206, such as quarterly projections and pro forma financial statements. Instead, the plan would just have to document the drop in the net worth ratio as predominantly due to share growth. If the net worth ratio fell for another reason, such as losses, the credit union would be required to submit a net worth restoration plan that included the content requirements outlined in the existing regulation. In addition, if a credit union falls below undercapitalized status, it would be required to submit a net worth restoration plan that complies with the content requirements of the current regulation. In accordance with the Federal Credit Union Act and MCUA regulations, the regional director will consult with the applicable state supervisory authority when evaluating a federally insured state chartered credit union's net worth restoration plan, including a streamlined plan authorized under this temporary rule. Similar to current practices, the regional director or state supervisory authority may determine not to approve a net worth restoration plan. Even streamlined plans submitted under this authority. In such instances, the credit union would need to submit a revised net worth restoration plan in accordance with Part 702. The authority to submit a streamlined plan would sunset on March 31st, 2022. Regional offices would continue to monitor credit unions' financial trends throughout the remainder of 2021 and in 2022 and beyond. If a credit union's streamlined net worth restoration plan was approved, but its net worth subsequently declined due to losses or other reasons, or reasons other than share growth, the regional director would require the credit union to submit a revised net worth restoration plan in accordance with Part 702. While share growth might be one reason for a credit union's net worth ratio to decline, there could also be instances where net worth falls as a result of negative earnings. We understand that credit unions are continuing to do their best to work with members and provide relief where possible. Some credit unions are waiving fee income, providing forbearance on loan payments, or experiencing an unexpected increase in expenses. This may result in reduction in earnings and net worth, and could make a credit union subject to the earnings retention requirement under prompt corrective action. Currently, credit unions that are classified as adequately capitalized or lower must transfer at least 0.1% of their total assets each quarter from undivided earnings to the regular reserves account. Under the current rule, credit unions may submit a request to the MCUA to transfer an amount less than 0.1% if they are unable to transfer this amount. This rule would provide the MCUA board with the flexibility to issue an administrative order specifying temporary revisions to the earning retention requirement for adequately capitalized credit unions. To the extent the board determines that the lesser amount, A, is necessary to avoid a significant redemption of shares, and B, would further the purpose of this part. When issued, this order essentially will permit a credit union that is classified as adequately capitalized to transfer a lesser amount from undivided earnings to its regular reserve account without having to request such authority from the NCUA each quarter. However, the regional director may require a credit union to submit a written request to transfer a lesser amount if the credit union poses an undue risk to the National Credit Union Share Insurance Fund or exhibits material safety and soundness concerns. I want to clarify that this authority granted under the prospective administrative order to transfer a lesser amount will only be applicable to credit unions that are classified as adequately capitalized. Those that fall to undercapitalized or lower, meaning their net worth ratio is below 6%, would still be required to submit a written request if they're unable to transfer the amount required in the regulation, unless they are operating under an approved net worth restoration plan that provides for a decrease or decreasing their earnings retention requirement. I will now turn it over to Tom to discuss the NCUA's authority to make these regulatory changes.
Thank you, Catherine. This is Tom Zills. The regulatory changes discussed today are within the board's authority under the Federal Credit Union Act. As Catherine stated, the current regulation provides that the board may waive the earnings transfer requirement on a case-by-case basis upon application by an affected federally insured credit union. The Federal Credit Union Act provides broader authority for the board to issue an order to waive this requirement and does not require an application or individual orders. The provisions of the April 19th interim final rule allow the board to issue an order applicable to multiple credit unions to waive the earnings retention requirement without individual applications. This provision was effective upon publication in the Federal Register on April 19th, 2021, and will expire on March 31st, 2022. With respect to net worth restoration plans, the Act requires a credit union that is less than adequately capitalized to submit an applicable net worth restoration plan to the NCUA. The NCUA, by regulation, has provided additional details to flesh out this statutory provision. The interim final rule addresses the Act's requirements for the NCUA to review these plans, but streamlines the documentation requirements. As Catherine noted, if the region finds that the growth is not temporary or the net worth declines due to losses, the regional director can require the credit union to submit a net worth restoration plan that complies with existing content requirements. The relief measure will also sunset on March 31st, 2022. This concludes our prepared remarks. We will be glad to answer any questions you may have.
Thank you, Tom and Catherine, for your informative presentations today and for the work by you and the rest of the NCUA team in quickly bringing these measures before the NCUA board. I would also like to thank Vice Chairman Huffman and Board Member Hood for their support for renewing these relief measures. These targeted, tailored, and temporary provisions provide much needed relief at a critical time. Just as we are seeing downward pressure on the net worth ratios of federally insured credit unions, the inflow of share deposits resulting from 3 fiscal stimulus packages and changes in consumer behavior resulting from the COVID-19 pandemic are affecting the equity ratio of the Share Insurance Fund. Normally, around this time of year, pursuant to our statutory responsibility, the NCUA board would consider the staff's 6-month projection of the equity ratio. Because the equity ratio projection has real consequences, my fellow board members and I believe it is important that the projection is as accurate as possible. The pandemic's impact on the economy and the government's related fiscal response has increased uncertainty related to key drivers of the equity ratio, especially insured share growth. Therefore, we have determined that it is prudent to undertake additional analysis for the projection, including reviewing the first quarter call reports of federally insured credit unions, which will be submitted in the coming days. The NCUA experts have been working diligently to answer all of my questions about these issues, as well as those of my fellow board members on this important calculation. I am thankful for all of their hard work, and I also appreciate Vice Chairman Hauptman's and Board Member Hood's engagement with the NCUA team and my office on this issue. We are all striving to ensure that we continue to manage the Share Insurance Fund in a prudent way, which by law is one of the board's primary statutory responsibilities. Now, returning to the matter of the interim final rule. Last year, the credit union system as a whole experienced an increase of $242 billion, or 19.8%, in insured shares and deposits compared to year-end 2019. This growth resulted from 2 rounds of economic stimulus and changes in consumer behavior. For many credit unions, this extraordinary share growth was even larger. I recently spoke with a small credit union, a CEO and manager, who said that the assets of his institution grew by 57% during the last 5 quarters because of the unprecedented share growth. The interim rule the NCUA board approved last week is substantially similar to the one previously adopted in May 2019 and which expired at the end of December. This rule makes 2 short-term but important changes to our prompt corrective action regulations. The first change temporarily reduces the earnings retention requirement for federally insured credit unions classified as adequately capitalized. While the rule is in effect, those credit unions unable to meet the earnings transfer requirements will not have to submit a written application requesting approval to decrease their earning retention. The second change temporarily permits an undercapitalized credit union to submit a streamlined net worth restoration plan if it becomes undercapitalized primarily because of share growth. If a credit union becomes less than adequately capitalized for reasons other than share growth, it must still submit a net worth restoration plan under the current requirements in our regulations. Given the ongoing uncertainty associated with the pandemic and continued elevated levels of insured share growth resulting from the 3rd stimulus package, many well-run credit unions with positive earnings could continue to experience falling net worth ratios this year despite being well managed and fundamentally safe and sound. As a result of this change, eligible credit unions will be able to focus their limited resources on serving their members' needs, especially those of modest means and those disproportionately affected by the pandemic, instead of planning for earning transfers and developing detailed net worth restoration plans. Lastly, at some point, the rate of share growth will return to normal patterns. Until then, the NCUA will continue to have its experts focus on the fundamentals of risk management and governance when examining and supervising credit unions, rather than the financial and economic shocks of the last year. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. I want to say thank you to the Chairman for having a good idea to talk about the equity ratio, even though it's not one of our 2 official agenda items. Just 2 thoughts on the equity ratio. One is all parties here are aware of our fiduciary duty to protect the Share Insurance Fund, and we take it very seriously. Protecting the SIF is the true north for any board member. And the second thing is all parties at NCUA are also aware of the unusual situation brought on by the pandemic and the government response to that. We also know what a true-up is. And we're aware that the solution to someone like a credit union having a tough time, meaning their net worth ratio is falling, the best solution is not to say, your solution to your money problems is to send me a bunch of money. We prefer to avoid that if we could. So that concludes my discussion on the SIF. Mr. Chairman, are we now asking questions on the interim final rule as well?
Yes.
Okay, gotcha. Regarding the interim final rule, just want to say publicly that, we get it. We at NCUA understand what's happening now. temporary pandemic-related factors are affecting both the share insurance fund and the net worth of many credit unions. And as credit unions continue to support their members, many are concerned with the challenges they face if their net worth ratio drops below the well-capitalized level. The latest government relief packages compound the problem, as it were. And it's no secret that nearly all of the share growth is held in highly liquid, short-term safe investments. That's because a lot of this share growth is what we call hot money, meaning the cash arrives suddenly and may well depart suddenly. It reminds me a bit of watching the tide come in. And if you didn't know how tides work, you'd see the tide coming in and think it will keep going and cause a flood. But fortunately, we at NCUA understand what is causing this proverbial tide of share growth, and we also understand what will cause it to recede. Not to mention, we at NCUA still have other real problems to focus on, instead of pressing well-run credit unions about temporary drops in their net worth, even though we know exactly why that is the case and why this tide should recede. If we did not provide network flexibility, that would result in pressure to increase yields on loans and investments, or take loans and investments with higher durations. And that is not the right thing to do with hot money. So I think there are things we can follow regarding what the FDIC has done and their restoration plan, the way they have dealt with their entities and their equity ratios. So I have a couple questions to ask, if I may. Regarding the pressure to reverse net worth ratio trends, and they may have pressure to seek more risky forms of loan products and investments. What kind of advice would you provide to boards and senior leadership beyond don't chase too good to be true investments?
Thank you, Vice Chair. This is Catherine, and I'll try to address your question. We will continue to encourage our credit union boards of directors and management to ensure any changes or shifts in the loan products or services are in line with their overall strategic plan, risk tolerance, and operating policies of the credit union. Credit union management should determine whether a new product or service is permissible under NCUA's rules and regulations and conduct appropriate due diligence. In addition, credit union management should consider how new products and services fit into their credit union's overall risk profile. When considering a new product or service that may present greater risks to the credit union, management should also ensure it has the proper policies and procedures and controls in place to insulate themselves from further risk down the road. And this concludes my remarks.
Thank you, Catherine. This is Kyle Houtman again. Can you address when an examiner is in the room, or on a virtual examination, we have this situation, credit unions, net worth ratio drops below well-capitalized. It's fairly obvious why. They're just below the well-capitalized level. How should they expect examiners to speak about this issue?
Thank you. This is Catherine again. As discussed in the interagency guidance issued in June 2020, examiners evaluate capital relative to the nature and extent of the credit union's risks. When evaluating the capital component, examiners will consider the institution's capital planning efforts. Examiners will evaluate the institution's capital projections and whether institution management appropriately assesses the institution's capital needs and vulnerabilities related to the pandemic and consistent with the institution's risks. If an institution's risk profile is not supported appropriately by its capital levels, examiners should determine whether management has a satisfactory plan to maintain capital adequacy and, if needed, build capital. Examiners should discuss with management the institution's plans for ensuring capital adequacy. In assessing capital adequacy, examiners will consider the institution's regulatory capital ratio, capital planning, and distribution plans. risk management practices, and whether an institution maintains a fundamentally sound financial condition. NCUA has instructed its examiners to continue to be flexible and reasonable when working with credit unions. To ensure our approach in addressing COVID-19 related matters remains consistent, the NCUA has instituted an enhanced internal review process of all examination reports. A credit union should work with their examiner if it requires flexibility in meeting deadlines or has concerns about its examination report or an examiner's supervisory approach, including the net worth planning. Should a credit union find it's not being afforded the flexibility it needs, credit union management should contact their supervisory examiner or regional office. That concludes my answer.
Thank you, Catherine. This is Kyle Hutton again. We were talking about this issue with one of the credit union leagues, and the head of the credit union league, with all the credit union executives, on the Zoom call, said, that they're hearing people falling just below, and even though they're not being issued a PCA, they're still getting pressure on it. And we followed up to say, okay, that's interesting to know. Can you provide us any details? You can even do a hypothetical, and can you come back to us so we can work on that issue, And the head of the league wrote back a number of things, but the first sentence was, the head of the credit union league is referring here to their members, the credit union management, and said, people have been a bit apprehensive to say much, but here's what I have. My question, and this is not entirely yours, to solve, but my question is, why do you think the credit unions were a bit apprehensive to say much, to give us details on this?
Good morning, Vice Chairman Hoffman. This is Vicki Narwald, Acting Associate Director in the Office of Examination and Insurance, and I'll respond to that question. It's unfortunate to hear that there are individual credit unions that are apprehensive about providing details regarding their experiences with NCUA examiners. The NCUA has taken several measures to ensure transparency and enhance communications. From the beginning of onboarding and training processes, we promote the importance of communication. We provide training to examiners and other NCUA staff on effective communication strategies. We recognize that often conflicts develop when communications break down, and it is imperative to address this timely. In addition to training, the National Supervision Policy Manual outlines certain specific communication requirements for NCUA staff. The goal of these policies and required communications is to ensure that credit union management receives timely information and is provided ample opportunity to consider and respond to any identified concerns. It is also important to note in 2018, we improved our appeals regulation went into effect. These appeals procedures provide a detailed and transparent mechanism for federally insured credit unions to appeal material supervisory decisions. The NCUA has seen this mechanism successfully utilized by several credit unions in recent years. The NCUA's role as both regulator and insurer may cause some credit unions to be hesitant to discuss concerns regarding an examination. However, we continue to encourage transparent communications. While the examiner is the first line of communication, credit union management should discuss concerns with the assigned supervisory examiner or regional office as necessary. And if there is a concern, we hope to hear from that credit union. That concludes my response, sir.
Thank you very much for that. I think we all agree it's a systemic issue whenever there's a power differential. I know that the Fraternal Order of Police and others actively encourage the use of body cameras, right? The good cops always want them, right? It provides transparency. gets them out of trouble if someone says something didn't happen. And I think we all agree that all of us are different when we know something is recorded, such as this call today. Is it true that credit unions are permitted to record their interactions with NCUA employees, like examinations?
I think that's a legal question. I don't know if Tom has an opinion on that.
My understanding is that it's allowed provided NCUA gets a copy of the file. You probably have to upload it to something. That is my understanding. Okay. Are there further steps we could take to increase transparency and reduce unintended confusion about interactions, such as encouraging recording of exams or having an Uber-style immediate feedback where nobody has to actually call the ombudsman and put their hand up and be singled out as somebody who sort of complained, but rather make it part of the process where we communicate to all parties what our priorities are and what sort of things we expect of all parties in exams?
This is Vicki, and I'll respond to that again. So there will be situations, obviously, where the credit unions that we regulate or insure do not fully agree with our concerns. This is perfectly normal, as you said. It's important for credit unions and examiners to remember our shared interest in protecting the health and viability of the credit union for the sake of its members and the safety of the share insurance fund. We will continue to promote open and transparent communications and hope that credit unions will speak up if there's a concern. The appeals process is one avenue for doing this. I would also like to remind credit unions that the NCUA has no tolerance for retaliation. Thus, any apprehension about coming forward with concerns should be alleviated. And that concludes my response. Thank you.
Okay, thank you. And let me just ask about other regulators for a moment on pandemic-related issues. Last year, as you know, the Federal Reserve excluded treasuries and central bank deposits from the leverage ratio, the supplemental leverage ratio, and I believe they're considering extending that. Are there any similar actions that we may consider in terms of the definition of total assets?
Hello again, this is Catherine, and I'll try to address that. Yes, you're correct. Other financial regulators have provided relief related to the pandemic capital concerns in a myriad of ways. As you noted, the Federal Reserve Bank issued capital relief on a temporary basis for certain institutions. The final rule applies to the computation of the supplemental leverage ratio, which impacts only the advanced approaches institutions, generally those with assets in excess of $250 billion, and is separate from the leverage ratio. This temporary relief, which has since expired, provided relief to a capital standard which NCUA does not have an equivalent to, and applies to institutions much larger and much more complex than credit unions. An additional measure of relief came from the other federal banking agencies and their adoption of a reduced community bank leverage ratio requirement for certain qualified community banks in response to the CARES Act. The initial relief reduced the CBLR from 9% to 8% and then gradually reestablished the CBLR at 9%. More recently, the other federal banking agencies set the CBLR to remain at 8% through the calendar year 2020, and it will be 8.5 through calendar year 2021, and then will return to 9% thereafter. It is important to note certain qualified community banks opt into the CBLR framework, as it enables those institutions to circumvent the complexities of the risk-based capital requirement. However, it generally requires those same institutions to hold a higher level of capital. Again, the NCUA does not have a similar CBLR capital framework excuse me, though an advance notice of public rulemaking was approved in January 2021, contemplating revisions to our capital framework, including the complex credit union leverage ratio. During the same period, the NCUA has taken several steps to provide relief to credit unions experiencing a stressed net worth position as a result of COVID-related growth. In addition to the earnings retention relief and streamlined net worth restoration plan relief discussed today, the NCUA provided relief by permitting credit unions to exclude PPP loans from their net worth ratio calculation, thus lessening the strain on net worth, as you have mentioned. However, as to excluding additional items from the definition of assets, this is not deemed necessary at this time, as the initial exclusion of PPP loans only provided marginal relief for credit unions' net worth ratios given the excess liquidity from deposit growth during COVID. Further, it's important to note credit unions in general account for assets in accordance with generally accepted accounting principles. The further exclusion of assets for the benefit of improving net worth may cause increased confusion compared to the benefit. The NCUA staff will continue to use all resources appropriate to address credit unions impacted by the COVID pandemic on an individual basis as appropriate. In summary, capital adequacy standards are an important prudential tool to ensure safety and soundness of individual credit unions and the credit union system as a whole. Capital serves as a buffer for credit unions to prevent institutional failure and dramatic deleveraging during times of stress. During a financial crisis, a buffer can mean the difference between survival or failure of a financial institution. Higher levels of capital insulate credit unions from the effects of unexpected adverse developments in assets and liabilities. Reduce the probability of systemic crisis, allow credit unions to continue to serve as credit providers during times of stress without government intervention, and produce benefits that outweigh the associated costs. I hope this addressed your question.
That has. Thank you very much. And my last thing I want to say is just back to Victoria, just to close the loop on that, just so I'm clear. Maybe I should be. Apologies. Were we to normalize the recording of the interactions, making it clear, NCUA thinks this is a useful practice. Let's say it was normalized and 95% of exams are recorded. Victoria, do you feel that that would increase transparency, decrease it, or have no effect?
Are you asking for my opinion? I'm sorry, this is Vicki.
Yes. Just given that, your experience with exams and, you know more about the direct credit union touching aspect of this than I do. Yes. Do you think it would,
certainly,
kind of like body cameras, where in California they found that not only crime fell, but complaints against police fell. The point isn't just to catch them, it's to change people's behavior. The same way this call is recorded, human nature, we do that. Let's say they were all recorded and we didn't have to speculate or argue about what might have been said or not said. And we communicated at the end of each exam, here are our priorities, kind of like when you get out of a Uber or a Lyft, first thing it says is, was the car clean? That communicates to everybody that the car is supposed to be clean, right? And that by itself solves a lot of the problem, right? Do you think that recording and measures such as what I just said would increase transparency or decrease it or have no effect?
So I think it would both, right? So I think to the extent that all the parties know they're being recorded, they would obviously exercise caution in the words they use and the topics that they discuss. So you wouldn't have, I guess, inappropriate incidents, let's say, right? Because everyone knows they're being recorded and there's a verbal record of the discourse. However, I think when conversations occur in the course of, exit meetings or otherwise where, examiners are engaging with credit unions and they're trying to resolve issues and come to common understanding and corrective action, I think that the recording of the conversation could, to some extent, inhibit the free flow exchange of ideas and discussions. for fear that, there'd be repercussions, right, for maybe a misstep in something that they say, or, that may not be protocol, or, follow the standard precisely. And I do think that there would be some unintended consequences as well. I hope that answers your question.
Who is, when you say they may be concerned about, not following protocol, who is they?
Well, it could be on both sides, right? So it could be examiners' fear of, not citing policy correctly or regulation correctly, or making, the appropriate recommendation. But it could also be on the credit union side where, maybe they have questions that they would normally ask, but if the conversation is being recorded, would not necessarily feel as comfortable asking those questions for fear that that could later be used against them somehow, right? Like they didn't have all the answers, or they should have known the answer to the question. So I think it works both ways.
Thank you for that. I'll say that in my conversations, and feel free to chime in if you've heard otherwise, with the credit unions, they are nearly universally in favor of these sort of transparency methods. I have not heard a single word against them. They're quite used to doing these things in other aspects of their life, and including like the end of exam survey. The state regulators often do this already, so it's notable that NCUA does not. Do you think it is worth doing some kind of survey or poll of credit unions to see how they answer that question?
We could certainly entertain that. Another thought that I had that I wanted to mention is just, with regards to fraud, sometimes, someone will identify fraud in a credit union and report that activity to an examiner. They may be less inclined to do that if they're being recorded. Similar, I guess, as you might understand, to a person wanting to report something to law enforcement anonymously, right? They don't necessarily want their name associated with it, with the reporting of it. So I hope that answers your question.
That is an excellent point. I think that's why it's important. There are also separately anonymous ways to do this. Like the FDIC has their survey and it's anonymous. Now, some people get paranoid about it and think that it's not really anonymous. You're going to know the IP address of who submitted it online. But it's a very excellent point. I'm glad you brought it up, that there is a value to that as well. But I do think it's worth asking credit unions how they feel about this and to act accordingly. And just when I come back to, when I've studied the police example, the good police, the vast majority of them, they're very much in favor of the body cameras, and it's the bad cops who don't. And I think we at NCUA know which of those we want to be. That concludes my remarks. Thank you, Mr. Chairman.
Thank you so much, Vice Chairman Huffman. Board Member Hood, it's your turn if you'd like to make any comments or ask questions.
Great. Thank you, Mr. Chairman. And I'd also like to thank Catherine and Tom for their presentations this morning. Because of the pandemic and stimulus, I am concerned that credit unions may temporarily fall below the well-capitalized level and become subject to various prompt corrective action requirements. While this temporary relief wasn't widely utilized last year when it expired, it now appears we need this tool for credit unions. It is important to provide relief to credit unions of all sizes that experience a decline in their net worth ratio because of a rapid increase in shares due to the flight to safety. Today's rule temporarily streamlines our regulatory requirements for prompt corrective action without introducing undue risk, consistent with the NCUA's responsibility to maintain the safety and soundness of the credit union system. I have a few questions now. How many credit unions utilized this temporary provision before it expired at the end of last year?
Thank you, Board Member Hood. This is Catherine, and I'll address your question. The initial utilization of relief in the form of the streamlined net worth restoration plans was limited. One of the qualifying requirements to apply for the streamlined net worth restoration plan is the decline in PCA classification needs to be predominantly the result of growth. However, initially, some of the credit unions applying for relief in the form of the streamlined net worth restoration plan had other factors contributing materially to the decline in their PCA classification. The credit unions who were not afforded the opportunity to submit a streamlined net worth restoration plan had either supervisory concerns or non-COVID related financial issues. In reviewing the more recent financial trends, we're seeing more credit unions with declining PCA classifications as a result of share growth. In regards to the earnings retention relief, the order issued by the NCUA board in 2020 provided relief to all adequately capitalized credit unions, as they were not required to perform the earnings retention transfer. As of March 31st, 2020, there were 53 credit unions classified as adequately capitalized. This number increased to 89 credit unions as of the September 30th, 2020 call report data. Had the order not been granted, these credit unions would have been required to perform the earnings retention transfer of 0.1% of assets. If unable to perform the earnings retention transfer, those same credit unions would be required to apply for a waiver for each quarter they were unable to perform the transfer. I hope that answers your question.
Yes, it does, Catherine, and thank you. And any ideas to why staff did not recommend extending it before it expired at the end of last year?
This is Vicki Narwhal. I'll take that question, Board Member Hood. So staff, in performing prior analysis of the impact of the May 2020 interim final rule, did not recommend extension based on the limited utilization of the relief anticipated going forward. However, we continue to consider the issue and monitor prompt corrective action trends. With additional congressional action, including the Consolidated Appropriations Act of 2021 and the American Rescue Plan Act of 2021, intended to provide direct financial relief to individual taxpayers, we anticipated credit unions would receive a significant increase in deposits due to stimulus checks during the first quarters of 2021. Considering this additional information available following the expiration of the 2020 interim final rule, staff determined it was appropriate to recommend reinstating these amendments to the prompt corrective action regulations in Part 702 on a temporary basis. Following the December 31st, 2020 call report cycle, the need became apparent to continue the regulatory relief, as the number of credit unions continuing to see an increase in shares as a result of the propensity to save resulting from the COVID-19 pandemic was increasing. And that concludes my response, sir. Back to you.
Great. Thank you, Vicki, and thank you for being with us today. Another question I have, and that is, for credit unions who may be watching today, can you please reiterate or discuss in detail how this will work in practice if they are indeed experiencing prompt corrective action issues because of the influx of deposits caused by the pandemic and government stimulus? So just looking for useful application.
Thank you, Board Member Hood. This is Catherine. NCUA staff will continue to work with the industry, and more importantly, our NCUA examination staff will continue to work with their individual credit unions to address specific concerns. The staff will continue to be advised to assess the capital needs of each credit union comparative to the risk profile of that institution. If an individual credit union is experiencing a lower net worth position resulting predominantly from COVID-related growth, the staff will work with that credit union to help them understand the PCA relief in place. When evaluating the impact of COVID-related share growth, credit unions should also consider various rates at which deposits may increase or decrease and the resultant effect on net worth. Our regional directors will review individual requests for streamlined net worth restoration plans and approve these plans where appropriate. I hope that answers your question.
Yes, it certainly does, and thank you. And while I have no additional questions, I'd now like to take the opportunity to discuss the impact of share growth on the Share Insurance Fund because it's important as well. The 1% deposit paid by credit unions enables the fund to grow proportionately with insured shares. This is accomplished through the 1% true-up twice a year. I've been told that this month we will be receiving nearly $867 million based on credit unions' December 2020 insured shares total. In addition to this 1% deposit, we maintain a total fund equity between 1.2% of insured shares and the normal operating level cap, currently set at 1.38. Generally, outside this range, we must develop a restoration plan or pay a dividend. The financial data, both looking back and looking ahead in the immediate term on the NCUSIF, is consistent with recent years and how we report NCUSIF data. If a premium or a dividend is necessary, we must be fully transparent in presenting the fund's financial position. Currently, the equity ratio we report is accurate, but there is a timing difference in reflecting the true-up, the contributed capital, by credit unions. This can be a significant number, especially in this unusual period of share growth. As reported, the current timing difference of this true-up can create confusion in the credit union industry, within members of Congress, and the general public. In my view, when possible, we as an agency should work to limit confusion and misinformation when and where possible. This is especially important in the prudent management of the Share Insurance Fund, a core responsibility of the NCUA board. Today, if we factor in the true-up contributed, we have a revised equity ratio for all practical purposes. I know this is an incredibly technical issue, but it is incredibly important because this lag or timing difference can create an impression of an NOL that is too high, creating a dividend, or too low, necessitating a premium. With the effects of the pandemic, I think it is appropriate that the NCUA board temporarily consider adjusting the normal operating level back down to 1.30. If we experience or project greater credit union losses than anticipated, this can be revisited down the road. I look forward to working with the NCUA staff and my fellow board members on this priority as we continue to respond to the COVID-19 pandemic. In closing, if I may, Mr. Chairman, while I appreciate today that we've had a very robust discussion on two items that we've been briefed on, I'd like to ask that we work together in a bipartisan fashion in the months ahead to have board agendas that provide us with opportunities for robust rulemaking opportunities. I know that there are several items that all three of us as board members would like to move forward in the days ahead. So I look forward to working with you again in a bipartisan manner to move some of those rulemakings ahead for our industry. I have no further comments, and again, thank you.
And thank you so much, Board Member Hood, and I certainly know that we have opportunities that staff are working through still some of the proposals that we've had, for example, on the capitalization of interest as well as derivatives, where I'm hopeful that we can see action here in the near future. And I also do want to reiterate that each of us on the board, both you, myself, as well as Vice Chairman Haltman, are certainly all working towards ensuring that we continue to manage the Share Insurance Fund in a prudent way. That's the right thing to do for credit unions, their members, the agency, and taxpayers. That concludes our agenda today. There being no further business, we are hereby adjourned.